Brace the rudders! Raise the sails! Raise the sails!
Captain, an unidentified ship is approaching. Over.
Roger. Wait, is that an enterprise sales solution?
Reach sales professionals, not professional sailors. With LinkedIn ads, you can target the right people by industry, job title, and more. We'll even give you a $100 credit on your next campaign. Get started today at linkedin.com/results. Terms and conditions apply.
Hey, it's Paris. You know I love sparkly things, right? Like stars. Duh. And thanks to Hilton and AutoCamp, I just slept under them. Picture me, serving looks by the fire outside my luxurious Airstream, making s'mores with the kids, while a national park is our backdrop. The great outdoors meets Hilton hospitality. That's hot. Explore all the new ways to stay at Hilton.com. Hilton for the stay.
Hello and welcome to episode 981 of Fintech Insider. My name's David Barton-Grimley, Fintech Strategy Director right here at 11FS. The Tour de France, one of cycling's most prestigious events, is still being fiercely contested in the hills of France. But the real race, at least for us, is happening in the world of fintech. Which stories will break away from the pack and make it into this week's podcast as the standout headlines? Oh, I love that. Joining me to decide which stories take the podium are our medal-worthy panel of experts. First up, we have a welcome Fintech Insider return for Jason Mikula, founder of Fintech Business Weekly. Welcome back to the show, Jason. Could you tell us a little bit more about what you've been up to since I spoke to you last, I think?
Trying to enjoy the beautiful summer here in Europe and seeing if I can get away with taking one of those all-August European vacations. It's looking very doubtful, though.
God, I want that in my life. You know, like 6 weeks of summer, nothing. Well, welcome back, Jason. And next up, we have Julie Arnoux, Europe Commercial Head at Wise Platform. Welcome, Julie. Great to have you on the show. It's been a busy week for Wise, which we'll hear more about later. But firstly, could you tell us a little bit more about your role at the platform?
Thanks for having me. So Wise is a technology company, and we're building the best way to move money around the world, whether that's sending, receiving, or spending. And Wise Platform is basically the infrastructure that powers Wise.com. And it also powers a number of banks and non-banks around the world. So, for example, some of our partners include Monzo and 26 New Bank, but also Morgan Stanley, Raiffeisen Bank, and Standard Chartered, just to name a few. So the TLDR is that basically banks can access the infrastructure, the payments infrastructure that Wise has developed over the past 14 years to improve their cross-border payments offering, always focused on the pillars that Wise is known for, so speed, cost, transparency, and convenience. And my role is basically to go out and promote our services to banks and help them improve their cross-border payments offering.
Awesome. Welcome on board. And yeah, you've got some news to share, which we'll talk about in a little bit. And last but not least, we have Veronica Glab, independent fintech strategist. Welcome back, Veronica. What have you been up to since we spoke last?
Well, for the most part, I think I'm going to have a similar summer to Jason. I'll also be spending most of my summer in Portugal, enjoying a bit more sunshine than what I used to get in London. But I am going to be gearing up for a Brazil Investment Week at the end of September in London. So it's not going to be entirely restful, but I'll definitely be practicing my Portuguese and putting together some really cool Brazil and LATAM themed content for the autumn.
Oh, so cool. Yeah. So I'm looking forward to hear more about that after the conference. I mean, so much is happening in Brazil, right? It's so interesting. All right. And that's our panel. Now on to the news. And this one is from the papers. JPMorgan reportedly intends to charge fintechs for customer data. JPMorgan is reportedly planning to charge fintechs for access to customer account data via aggregators like Plaid and Yodlee. The fees vary by use case, but payments firms are likely to face the highest rates. This could add a potential revenue stream for JPMorgan of hundreds of millions of dollars a year, making a strategic shift to monetize data. Fintech stocks were reported to have dipped as the news broke, but analysts suggest it will have a limited long-term impact. JPMorgan has defended the move, claiming they are making investments in secure infrastructure and ecosystem-wide security. standards. So yeah, I remember when this broke, and there was a lot of, I think, drama. A lot of people panicked. There was like mass panic in the market. Jason, I'm going to come to you first. Like, what have you seen come out of this?
Okay, I promise I will keep this relatively brief, but it is important to back up and set some critical context, right? Which is that the Consumer Financial Protection Bureau, the CFPB, finalized the U.S.'s open banking rule, commonly referred to as 1033, just last October. That rule would require covered institutions, which would include JPMorgan Chase, to make data available at no cost for certain kinds of accounts. Specifically those covered by Reg E, which are checking and savings type accounts, Reg Z, credit card accounts, prepaid accounts, and digital wallets. Now, the very same day that rule was finalized last October, a trade group, the Bank Policy Institute, which represents some of the country's largest banks, filed a lawsuit arguing that regulator, the CFPB, had exceeded its statutory authority, including by prohibiting banks from charging fees, and that it formulated the rule in an arbitrary and capricious manner in violation of the Administrative Procedures Act. So this move from JPMC, from Chase, isn't coming out of nowhere, right? There's a backstory. And perhaps more importantly, in this lawsuit, the CFPB, keeping in mind that lawsuit was filed last October during the Biden administration, under its new acting director, Russ Vought, the CFPB quite literally changed sides in that lawsuit and is agreeing with the Bank Policy Institute and the other two plaintiffs that are seeking to overturn the rule, and has asked the court to vacate the open banking rule.
Wow.
Now, this case hasn't actually yet been decided. A different trade group, the FTA, which represents fintechs, was granted the right to intervene and argue in favor of preserving the rule, right? So that case is still pending. That's sort of like the backstory here. As far as the specific move, I'm not sure that I agree that the move from Chase here is actually about generating revenue from the data, so much as I think is about using Chase's mammoth market power to undermine potential competitive threats, particularly, as you alluded to, in payments-related businesses. In the U.S. case, pay by bank. Sources that I've spoken to who have seen the proposed pricing described it as quote-unquote punitive and literally an effort to kill off an entire industry. So it isn't just about cost recovery. It's about pricing this open banking data in a way that may make competing with Chase or offering products or solutions that compete with Chase just unviable given the economics.
Wow. That is way bigger than I thought. I mean, Veronica, what do you think about this?
So, there's two angles there that I looked at, sort of short term and longer term. And, if Jason takes the regulatory side, I really look at it from an innovation and investment side as well. Short term, if you're monetizing data, that might be great for JPMorgan. But what I would be really concerned about is how early stage fintechs are going to pay for that data if they need certain types of data to continue building new products and features. So I would hate to be a VC and see, a Series A company coming to me and saying, okay, well, we've now got to rebudget our burn rate because we've got to purchase this data that we are now dependent on in order to build our next rollout, our next product, our next feature. Maybe that's part of JPMorgan's strategy here, is to choke off a little bit of that competitive innovation. But I've also kind of got my own conspiracy theory soapbox here, that this, from an innovation angle, this could be sort of the first horseman of the really, really historic legacy banks bringing fintech into a moment of reckoning. We've always talked about fintech being more agile, more innovative, just faster, smarter, cleverer. But what fintechs, companies that are under 15 years old, do not have is centuries of historical data. So this is the first really big case we're seeing of a major legacy bank like JPMorgan leveraging historical data. This bank was set up in 1799. It's the original Wall Street bro bank, Alexander Hamilton using it to supply Manhattan with water. like dig into it. I'll try to keep this a little bit short, but if you talk about a bank like JPMorgan who have this very tech forward strategic angle about their future as a bank, or maybe it's a Santander or a Coutts Bank who have literally centuries of historical data of end customer usage and behavior, macroeconomic data as well, recession data from decades and decades and decades. There's banks out there that are almost as old as the bubonic plague. Imagine if they actually start monetizing that, of developing their own LLMs to process that data into narrative and strategy. So without going too deep into that sort of wormhole there, yeah, I think this first real strategic monetization of data says a lot more than just making cash off of a product, but it's really banks leveraging centuries of what has already been always theirs.
Yeah, and it sounds like this is like the opening firing gun of this. I mean, just echoing what both of you are saying, I mean, certainly one of the meta themes that I've been hearing from bankers over the last decade is, all this is very great, but someone has to pay for this. Like, we are covering the cost of this infrastructure, and somehow at some point there is going to have to be a reckoning. And yet the entire open banking ecosystem, and therefore by extension a portion of the fintech ecosystem, is based on the assumption that there is this open data. So there is this, both of you are saying there is this kind of like arbitrage between those two very different point of views. It is absolutely terrifying, and it's an international ramification. So Jason, this is a US-focused charge, right? Is this not, I needed to check into it a little bit more, whether this is global or whether this is just the US.
Yes, it is specifically referring to the US, and specifically referring to consumer accounts at Chase. So that would, full disclosure, I actually am a Chase customer, but that would be, checking accounts, savings accounts, credit card accounts. I do think it's worth clarifying that the way that this ecosystem works in the US today, you mentioned some of the aggregators. So companies like Plaid, like MX, like Finicity, those companies generally build the integrations with the banks, the credit unions, other financial institutions. It's also worth remembering that the United States has something like 10,000 banks and credit unions. So the idea that Wise or any other fintech company would go and build 10,000 integrations, and every single fintech that wants access to consumer banking data would likewise build their own 10,000 integrations, is just sort of like ludicrous on the face of it. Like, there is a real value add role that the aggregators like Plaid, like MX, like Finicity play. I think the challenge, and you make a fair point, and I think Jamie Dimon surely would agree with you, that the underlying banks, Chase included, do have to spend real money to build and maintain those APIs that aggregators plug into. So I think there is a real question of who bears that cost and how is that cost distributed. If you look at something that is somewhat analogous, which is the debit card space in the United States, when Dodd-Frank was passed in the wake of the financial crisis, part of that was the Durbin Amendment. We're most familiar with this talking about banks that are exempt from it, but banks that are covered by the Durbin Amendment, like JPMorgan Chase, the amount that they can charge on a debit transaction for interchange is regulated, and that formula to compute how much the banks are able to earn is designed to facilitate cost recovery. Basically, what is the actual cost of providing this debit card service, and allowing the interchange rate as a cost recovery. So this is not how the discussion around open banking data has evolved in the US, but I do think there is a legitimate question of, hey, if you're Chase, if you're Bank of America, if you're Wells Fargo, building and maintaining those APIs, securing customer data, that really does cost money. And so you can understand why the financial institutions would want to at least be able to sort of break even or recover that money. That's not what is happening here. I haven't actually seen a full copy of the pricing sheet, but the way it has been described to me from people who have seen it, particularly for payments use cases, is that it is just prohibitive to the point where you would not actually be able to build a business off the back of it. Now, I think it's also worth remembering, like, what are the things that open banking data enable? We tend to talk about it at this sort of like 30,000 foot abstract level. But since we have someone from Wise here, and I'm apparently like a Wise power user, one of the things that open banking data enable is this monitoring of account data to underwrite credit risk. In the Wise case, that's doing something like saying, hey, I want to send $200 from my Chase account to, Mexican pesos to my friend. If you want to have that look and feel instant, Wise needs to be sure that you actually have that money and that you didn't just open up that account yesterday. And when that ACH debit hits, it's going to bounce back and say, oh, Jason actually scammed you. He doesn't have any money. Similarly, using open banking data for cash flow underwriting of consumers who don't have credit scores, or linking their bank account to services like Venmo and Cash App. So there are real consequences should this data become either unavailable or just economically impractical to use.
And as the walls go up, and if those walls go up, consistently, if all of the other incumbents, then before you know it, the whole economic model of fintech begins to kind of disintegrate in some ways, which is a little bit terrifying. Unfortunately, we're out of time on this, but I suppose we could dedicate an entire podcast. This is so fascinating. And I guess much needs to be seen of what actually happens to this lawsuit or regulation as time goes by. So I'm sure we'll be talking about this again in no time. Right. And this next one is from Fintech Finance News. UniCredit becomes first major bank in Europe to launch fast, secure foreign currency payments through partnership with Wise platform. UniCredit has become the first major European bank to integrate Wise's payment platform, launching fast, low-cost FX transfers directly in its app. The service will be available from July the 21st, 2025 for Italian retail customers, with more currencies to come. Transfers are near instant, often taking just a few seconds, with fees up to 80% lower than traditional international payments. Wise provides the infrastructure, giving access to 90-plus local banking networks, 70-plus licenses, enabling UniCredit to bypass slow correspondent banking systems. So, Julie, we obviously have to come to you first on this. Tell us a little bit more background behind the partnership. How did it come about? And what makes this a European first?
Cool. So I guess just setting the scene a little bit on why UniCredit would be interested in partnering with Wise. In the past, I'd say decade, probably 15 years, we've seen a lot of new banks and also non-banks kind of enter the market of financial services. And they're offering really, really compelling products to consumers. And so naturally, consumers who used to, only have one bank account with their bank and, just go to their services for absolutely everything, they're kind of now like shopping around and looking for the best service out there. So they're looking for the best price, they're looking for the best quality service, they're looking for a great user experience. And so there's a reality today where we're seeing like people have a lot of different apps, a lot of different providers for a number of different services. If I look at this personally, I used to have a bank account in the UK where I live, a bank account in France where I'm from, and that was basically it. Today, I have like 10 different apps, right? I have Wise for my cross-border payments, I have Nutmeg for my investments, etc. And so the issue that banks are kind of feeling now is that customers are churning on specific products. So, for example, in our world, we see customers leaving their bank because they're not really satisfied with the quality of the service and the price of their cross-border payments. And so they're going to other services like Wise, but like other providers out there too. And once, as a consumer, once you've downloaded a new app, you've gone through the KYC, just for this one service, you're likely going to spend a little bit of time in the app kind of checking out what are the other services that I could use with this new provider. And so what banks kind of started feeling is there's churn on this one specific product, which is kind of like trickling down to churn on other services. And so customers are leaving them for cross-border payments and then slowly also leaving them for cards and day-to-day banking and all these other services that banks really, really care about. And so banks need to react really quickly to this in order to keep customers within their ecosystem. And that's exactly what UniCredit have decided to do. They've really invested into this, into payments in general over the past few years, and now more specifically into cross-border payments, because they want to keep their customers happy when they're within their ecosystem, and they want to make them more sticky with just an excellent level of service for cross-border and for payments in general. So with Wise, of course, they're focused on how do we charge the lowest possible fees for payments? How do we offer instant payments? Instant for us means less than 20 seconds. I can send money from the UK all the way to Brazil in less than 20 seconds end to end. They're also interested in transparency. So how are we transparent in terms of the fees that we're going to charge the customer, but also throughout the experience of the transfer, how can I at any point of time look at the status of my payment or what's going on with my payment? So really pushing that level of transparency throughout the customer journey. And of course, a really strong user experience. Today, we're really used to doing everything with like a few taps on our phone. It needs to be the same for cross-border payments. And so cross-border payments is really a strategic initiative. We're seeing a lot of banks do this now in Europe, actually, to keep your customers within your app and to kind of push back the threat a little bit of these banks and non-banks that have entered the market in the past 10 years.
That's awesome. And can you tell us a little bit about what makes it a European first? Is that like a first for Wise, or is that like for this particular product set, or?
Kind of both, to be honest. It's a European first because it's the first major bank in Europe that leverages Wise platform. So first kind of for us and kind of for European banks too. And what's super exciting is they're rolling out this new service next week to 15 million customers. And it's also a first, if I can just add a little bit there. Traditionally, banks, when they set up their infrastructure to make international payments, they use correspondent banks, right? So it's a big chain of like a number of different partners that allows you to move money literally from point A to point B. So it's super exciting to see a bank of like the size of UniCredit kind of change completely the traditional setup that they're used to with these services, and rely on and leverage basically the payments infrastructure of Wise, but also our technology and our expertise within cross-border payments.
It's very, very cool. And I love that background that you gave, around the sort of threat of fintech and challenger banks eroding, customer trust and stickiness. At 11FS, that we also see the same fear and the same kind of stats coming through from banks. So it's very interesting. Veronica, would you echo this as well? Are you seeing that the incumbent banks now really pay attention to, maybe solving some of these? I mean, they're product issues, but they're also UX issues, right? Like FX in some ways is also a UX problem, right?
Yeah, I think the UX piece for me is actually quite interesting as well. I always love a cross-border payments story because I am also I grew up in the remittances economy. So every time that you make that user experience better, you could be relieving one customer of massive anxiety around an urgent payment that has to be made. But when you put that at scale, particularly in any European market where people are actually really quite mobile, it's super exciting to see. So the UX piece, the faster you can make that payment is one thing, but also the better that you can make the user experience, it genuinely does at scale make a massive difference in customers' lives.
Absolutely. I mean, Jason, what's the big partnership story here? I mean, Wise is a fantastic example of a business that has like platform-tized. I don't know, I just made that word up. I'm sure there's something more. I'm sure there's something better here. And it's definitely a thing that you see in fintech, launching a product and then launching a technical solution or a platform and then, sort of scaling through that area. Are there any kind of headwinds in that model, or do you see that just continuing to expand?
I mean, I think, one of the challenges is FX and international payments remains a highly profitable business for banks because of all of the friction and the lack of transparency that Julie's talking about. I mean, as she was describing that, I live here in Europe, so live most of my life in euros. I'm American. I also run a small business in Mexico. And I can tell you both the UX on the bank I use in Mexico, which shall remain unnamed, and I've done the math on the foreign exchange rate, and they don't make it clear that you're eating, hundreds of dollars, obviously depending on how much you're sending, in dollars or euros that are baked in to the foreign exchange rate that they're giving you, right? So if I'm a major bank that sees foreign exchange and international payments as a huge revenue driver and profit center, why would I want to adopt something like Wise Platform, which maybe is a much better experience for my customers, but it's eroding that revenue that the bank is generating? And I think that that's true across a lot of different product lines. So it's like you end up getting what Julie is describing, which is all of these point solutions, which is like, oh, well, whatever. I bank with Santander, but like these 4 features are either the UX is bad, they're too expensive, it's hard to use. So I'm going to go adopt Wise. I'm going to go adopt, Robinhood or some other capability because the ones that are sort of bundled in to my core banking experience are just bad. And on the one hand, maybe that solves that specific pain point for that individual consumer, but now they have a different challenge, which is managing 5, 10, 15 different apps for all of these different tasks, all the different jobs to be done. So, I mean, I think, like I said, I actually am like a Wise power user because of my weird distributed life, and it solves a real pain point for me that, Chase or my Mexican bank account or my European bank account don't solve.
Yeah. Yeah, no, it's Julie, I'd love for you maybe just to pick that up, because what Jason said there was very interesting, like those trade-offs, right, between an amazing UX experience, but also in some ways, losing that revenue. If, Wise is claiming the transfers are up to 80% cheaper, then how does UniCredit or another partner benefit financially?
I think what they need to remember is if you don't make this change to improve price and so the user experience, your customers have already decided to leave you and will keep doing this, right? And so you're already losing today on the revenue that you were previously making on cross-border payments because competition is now really high in the market. And next to that, you're losing customers on these other products that you really, really care about, because that's actually like where most of your revenue is generated, right? Like day-to-day banking, credits, mortgages. Like Wise doesn't offer these things, but we know other challengers that do, and that will keep, pushing all of the boundaries of all of the different bank products that they can offer today. So it's kind of the trade-off between. I don't think there is a trade-off. It's this or you've lost your customers and the revenue anyways.
It's becoming a no-brainer these days. This is just something you're gonna have to do. No, that makes sense. Thanks for that. And on that note, we're just going to take a quick pause here. Back shortly.
The McDonald's snack wrap is back. You brought it back. Ranch snack wrap. Spicy snack wrap. You broke the internet for a snack. Snack wrap is back. Ba-da-ba-ba-ba.
In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's vanta.com/insider. Welcome back. Before we get back into the news, we want to share our latest Insights episode with you. According to Marqeta's recent State of Payments report, 36% of businesses said integrating payment tech into systems is the biggest challenge, with a further 80% of SMBs are concerned about the US economy and its impact on their businesses. In this episode, we are diving into insights like these from Marqeta's report to dig into what's really keeping SMBs up at night and how can next-gen payment solutions help them stay competitive in a rapidly evolving landscape. I'm joined by a host of fabulous guests and experts in the payments field to help answer these questions raised by the report and look ahead to the future state of payments. The episode is out now. Just head to the podcast below this one. All right, back to the news. And our next story, this one is from Fintech Futures. Bilt's valuation soars to $10.75 billion following a $250 million funding round. Bilt has raised $250 million, boosting its value to $10.75 billion, up from $3.25 billion in 2023. So that's a huge boost in valuation. Backers include General Catalyst, GID, and United Wholesale Mortgage. Bilt lets users earn rewards on rent and mortgage payments, redeemable for travel, dining, and home purchases by operating a loyalty system with 40,000 plus merchant partners. It is thought they are aiming for $1 billion in revenue by Q1 2026. They have recently acquired Banyan to enhance purchase data insights with expansion plans, including student housing, HOAs, and mortgage integration. They also have plans to launch Card 2.0 in February 2026 with 3 tiers and a new issuer from Cardless. So this is super interesting, and also I feel like Bilt is just such an interesting business model. Jason, I want to come to you first on this because I guess maybe just by virtue of the fact that you are American and this is an American story, I don't know, no other reason. What do you think? It's a super interesting business model, sort of like loyalty, but tied to place, tied to location. I mean, yeah, what do you think about this?
Yeah, so I'll admit I primarily think about Bilt as a credit card issuer, but that is really not actually how the company and its co-founder CEO describe it. I mean, they describe it primarily as a loyalty and a rewards play, with the credit card being sort of a mechanism to sort of bootstrap that ecosystem. So you mentioned a new issuing partner, Cardless, which is the tech platform. They haven't actually named what bank will be replacing Wells Fargo as the issuer, although Cardless only works with a single partner bank at the moment. I believe it's First Internet Bank, which is based in Salt Lake City, Utah, which is a tiny, like less than 500 million asset bank. Really couldn't get more different than Wells Fargo than that. So I mean, it on the card side, the relationship with Wells Fargo, I think it's fair to describe as being a bit rocky in the sense that the assumptions Wells made about how the economics of Bilt's program would work for them just turned out to be totally wrong, right? They thought more people would have balances that they revolved. They thought that, they wouldn't be spending so much on rewards for the rent payments. And it turned out that per Wall Street Journal reporting, Wells Fargo said they were losing something like $10 million a month, which on the one hand, a bank as big as Wells Fargo, that's kind of a rounding error, but clearly it was a big enough problem that Wells Fargo has moved to terminate the relationship early. The contract was slated to run through 2029. And last I checked, it's only 2025, with that new version of the card slated to launch sometime next year. The Banyan purchase, also interesting for folks who aren't familiar. Banyan, I believe, does something along the lines of like SKU level or like item level data for transactions. So in the scheme of a loyalty and rewards business focused on serving merchants, having that SKU level data for users' purchases is something that can be very, very valuable, both for targeting, advertising and marketing to consumers, as well as for trying to prove effectiveness, proving if your loyalty program is working by understanding deterministically, did this person really go and buy XYZ product? And having that infrastructure that Banyan built should help enable that. The valuation jump, I'll say, is kind of crazy, and I'm always reluctant to play equities analyst because for a private market fundraise, we have no idea what kind of preference stack or other terms might be in that deal. So I will take a pass on speculating on the valuation.
Veronica, I mean, what do you think about, maybe if not the valuation specifically, but what is so exciting about this business model? Is it loyalty? Is that the theme?
I mean, honestly, I was surprised that they've made such a good turnaround as they have, because I actually remember when they had their big breakup with Wells Fargo, which, by the way, Jason, I remember you reported on that, and so did Fintech Insider. That was, that was supposed to have been a win-win partnership. And for Wells Fargo to pull out from that partnership early, it was kind of a scandalous piece of news, to the point that you think there's no coming back from this. But they've clearly come back by restructuring, some core parts of their business model. And I actually had a bit of a feeling over the last couple months that they were maybe going to gear up for some big announcement, because they've actually been massively advertising on sort of B2C podcasts across various podcast networks in the US. So like you could not listen to a true crime podcast in the US without having Bilt advertising their services. So so there were a few kind of indicators that they were really pivoting their offering. But, I am, I guess, kind of pleasantly surprised that they've just been able to turn around something that I thought there was really no coming back from, that they've been able to get these very big name investors to back them. So surely there has been a lot of due diligence for how they've pivoted. But it's still a hard one for me to put a finger on, just because it is a type of product that I honestly don't understand very well, of offering kind of a points club rewards and incentive scheme for something like rent, which is essentially a direct debit product. And that comes with its own kind of regulatory scrutiny around it. Then we start to get into, are you incentivizing loyalty for someone to stay where they are? What does that say about, like, I don't know, like urban planning, gentrification, redlining of incentivized schemes for renting where you rent? It's still an odd one for me. I think Jason probably would be able to explain it a lot better than I can. But again, coming from a very European lens, there's a lot of questions here that are tough for me to grasp.
Yeah, it's kind of confusing. I mean, even when you just go on Bilt's website, there's just so much there. There's so much going on. And it is also unclear, what is Card 2.0. I don't know what that is. Maybe I'm missing something, but I don't feel like that's been either disclosed yet or talked about in too much detail. I mean, maybe one of the plays is that with all the data they have, they start going into lending. Correct me if I'm wrong, but I don't believe that they're doing mortgages at the moment. Yeah, I agree kind of with both of you. There's a lot. Cool. Thanks, everybody. I mean, I think we're at about time on this. And if you want to learn more about the battle for loyalty in financial services, I'd like to shout out our 11FS Explores video here, featuring yours truly, which breaks down whether banks are losing their loyalty game and what loyalty really means in financial services. So give that a watch. And if you'd like to learn even more about how we can help, head to 11fs.com/ventures, and we'll leave the link in the show notes below too. All right, and this next article is from Sky News. Lloyds Banking, I think that should say Lloyds Banking Group, in talks to buy digital wallet provider Curve. Lloyds Banking Group is in talks to buy digital wallet provider Curve for somewhere between 100 to 120 million pounds. The deal could be finalized in September 2025. Curve lets users consolidate cards into one digital wallet, competing with Apple Pay. The estimated valuation is below Curve's previous 133 million pound Series C in 2023. Curve has raised 200 million pounds plus to date, but recently cut staff and paused US expansion. It is thought that Lloyds sees Curve as strategic amid pressure to reduce reliance on Apple Pay. It comes as regulators are seen to be probing Apple and Google's dominance in mobile payments. So this came as a huge shock to me. I mean, am I missing something here? Jason, was this a shock to you? I'm surprised.
I mean, a shock in the sense that I have a hard time imagining it turning out well.
Yeah.
I mean, certainly with the requirement to open up NFC, the near field communication chip, there is a window for other firms to compete in the digital wallet space, which is so dependent on convenience, right? The ability to tap to pay as opposed to having to, open up an app on your phone and scan a QR code or something, although that works for Starbucks. So I guess if you have a strong enough incentive and a high enough frequency action, you can get people to do it. I really struggle to imagine anybody besides, at least in the Western market, anyone besides Apple and Google who control, in most cases, in many cases, the hardware and the operating system. I have a hard time imagining any app or any bank being able to compete with that type of vertical integration as far as offering a low friction experience, right? And ultimately, when we're talking about what people reach for to pay, setting aside the American obsession with points, I think the number one thing when choosing a payment instrument is ease of use. And it's very difficult to beat Google or Apple when they control the OS and control the hardware. And also banks are tend to be very bad at making good user experiences, as we've already talked about.
Yeah. I mean, Curve is certainly trying, and we've had Curve on the podcast many times before. I would count them very much as a friend of the pod, and certainly some of the things that they've been doing have been fantastic, or at least seem fantastic to try to compete. But I guess you're right, Jason. That like it's very, very hard to get that scale. What do you think, Veronica?
Yeah, it's an interesting one. I mean, I do kind of see a threefold play here, which I do think Jason actually covered quite well. It's about payments dominance. It's also for Lloyds Bank as one of the big four banks, these legacy banks in the UK, to make a play for innovation and really, leapfrog some of their competition as well. And maybe it's a sort of a future sneak peek into breaking the sort of hold that Apple Pay or Google Pay have over the UK and maybe even later the broader European market, particularly in context of some of the conversations happening in the EU about, regulating Apple Pay in particular. So it's an interesting one. And, when I was having a few chats with other folks from the industry, particularly on LinkedIn, and commenting on sort of each other's thoughts and soapbox moments about it. And there was a little bit about it that did feel exciting, and sort of in the sense of like, ooh, a big legacy bank doing something cool, like very, very techie. And so there's an exciting piece about it that I think is hard to put your finger on, and leads me to think that the move was maybe in anticipation of something else that's going to happen in the broader ecosystem as well.
And Julie, to that broader ecosystem point, I mean, do you think there is something happening across Europe when it comes to payments? I mean, your news item is a good example of that, right? I mean, what do you think? Do you think we could see similar acquisitions in Europe?
I think just tying back to what I was saying earlier on, banks need to innovate. They need to, stay relevant for their customers. It can be building things in-house, but unfortunately, we know they don't always have the agility to do that if they want to go to market very quickly. Partnering, so like UniCredit and Wise, I think that's a great option, and we've seen a lot of this happen in the industry over the past few years. But buying is also 100% an option, and I think it's quite exciting to see banks really, really pushing this innovation and picking one of those three options to get there.
Yeah, 100%. I mean, it's so difficult to understand what has actually happened here and what is going to happen. Like, for example, do they keep the brand? Do they sunset the brand? I imagine they do keep the brand. It's very, very compelling. Curve has an incredible brand and a big presence, very, very well known and respected. So it'd just be interesting to see where this plays out. Jason, do you have a crystal ball? Could you crystal ball this, or is it just too early? I don't know.
I mean, it's probably too early, but I will hazard a guess anyway. I mean, big bank acquisitions of upstarts, of fintechs, I think have a majorly uphill battle to climb. I'm mixing all my metaphors now. Even if it's just from like a cultural perspective, right? I mean, I can tell you, having sat in both worlds, like small startup world and big bank world in my time at Goldman, they tend to be very, very different places with different functions leading, right? in fintechs, you tend to have engineering and product management as sort of the tip of the spear, as it were, whereas in banks, there tends to be much more focus on regulatory compliance, process, risk management. And I do think that those can be difficult cultures to mesh together.
Yeah, 100% agree with that. I mean, do any of us here have a good example that we can quote, maybe of an acquisition that has gone well? I know this is kind of off the cuff, but and if we don't, maybe that's a story in of itself. I mean, I'm sure there have been, but I agree with you, Jason. It's the exception more than the norm.
I like to say when HSBC took Silicon Valley Bank.
I think that is. I mean, yeah, the circumstances were obviously very, very different, but my God, yeah. I mean, HSBC Innovation Banking, they're killing it. That was an incredible
discount deal.
Yeah, absolutely, overnight. So I think that's a very, very good shout, Veronica. I think it can and does work when it needs to and wants to. So this is going to be one to watch and an open invite. If anybody from Curve or Lloyds Banking Group wishes to come on the pod, please get in touch. I'm sure we will find out more about this as time goes by. Okay. Now for a quick look at one more newsworthy story this week that we don't have time to cover in full, but we think you will find just as interesting. And this one is from Fintech Finance News. Monzo unveils flexible home insurance for homeowners. Monzo has launched content insurance directly within its app, becoming the first UK digital bank to do so. The feature is aimed at renters and homeowners with an emphasis on underinsured renters. The insurance is designed to cover theft and damage in and out of the home. The feature is designed as a monthly subscription package with no extra fees or loyalty penalties. This offering is part of Monzo's wider plan to expand into more embedded insurance offerings. To tell us more about this launch, we have a voice note from Phoebe Chibuzo-Hugh, Head of Insurance at Monzo.
At Monzo, we're always speaking to our customers to find out which parts of financial life they find most challenging. And it turns out, ensuring your home and belongings, your most important assets, is a big one. So we've built Monzo Home Insurance, our combined buildings and contents policy for homeowners. We've made it really simple to get cover, just 6 questions for a quote, with delightful touches throughout, like a shoe rack that stacks up when you add the people you live with. Everything is completely transparent. You can see your price change in real time as you flex cover amounts, excess, or add high-value items, like your bike, a piece of art, or an engagement ring. We also wanted to design something that really fits around our customers' lives and adapts with all the moves and milestones within it. So it's a flexible monthly subscription where customers can personalize their policy, make changes or cancel with no extra fees, plus start and manage claims directly in the app. This follows our contents insurance launch earlier this year, so we can now help everyone, renters and homeowners, to get properly protected. We've really pushed the boundaries of what insurance can be, and we're just getting started. We're excited to bring that same Monzo magic to all aspects of financial life. So watch this space.
And finally, not sure if any of you are Hollyoaks fans. I'm not. But we have a bit of an unusual story for you television buffs out there this week. This one is from The Independent. Hollyoaks, a British soap opera, is ruled to have breached Ofcom rules by promoting a fintech app in the episode. An episode of Hollyoaks, a British soap opera beloved by uni students, which is a long-running episodic drama series for our listeners outside of the UK, aired on the 18th of February, featured a character using and praising the ClearScore app on screen, where the app was clearly visible and the character discussed how it helped him afford a laptop for his son. Ofcom ruled it breached Rule 9.9, which prohibits promotional content, as well as Rule 9.10, prohibition of the undue prominence of a product. Channel 4 accepted the decision and said it would review its practices going forward. Do you guys think they got paid for this? I can't really tell.
I mean, we've established I'm American, so I'm used to just aggressive product placement everywhere all the time.
Oh, dear.
I wouldn't have it any other way.
Veronica, what did they? I don't know. I don't know what to think about this.
I don't either, but you've also got 2 non-British people commenting on what I understand as a British institution.
Oh, yeah. So maybe I should be the one that... I have seen Hollyoaks promoted on television constantly and have managed to avoid it. just by design. But I guess this thing does happen all of the time, product placements. So I just find it so fascinating how, like, at what point is it a rule breach if there's money being exchanged or not? It doesn't. Yeah, I don't really know. We have some suggestions for fintechs famous TV characters could use. So Homer Simpson could use Monzo pots to separate Moe's bar. Fleabag uses Tide to keep track of her spiraling guinea pig cafe expenses, or Ted Lasso using Wise to send money back to Kansas. There we go. That's one. that could make sense. So yeah, I mean, I'm going to ask this question because I'm just going to do it. Jason or Veronica, if you had a fintech product that you were promoting, where would you promote it?
Oh, that's a good question. I guess I watch so little TV. I'm like the wrong person to ask this. Love Island.
Yeah, give me that. That's an amazing. I wonder what feature they would use. Veronica, what do you think?
It would be the curve, go back in time to undo the bad date that you had with someone else in the villa.
Oh, fantastic. Those are two amazing.
Or White Lotus. We could do like a White Lotus collab.
Yeah, White Lotus.
Jason, I've got it.
Oh my
God. Now hear me out, Jason. What about a White Lotus budgeting app?
Yeah, save for your next holiday trip. I like it. Done.
Buy now, pay later to get into White Lotus.
And you could kind of bundle in some insurance there to make sure no one
need
murdered.
A lot of insurance.
Yeah. Pay a premium to have a bodyguard. Maybe not shoot you or shoot someone else. I don't know. We are massively digressing, but those were incredible examples. Thank you so much to today's guests. And where can people find out a bit more about you and your companies? Jason.
You can find me at fintechbusinessweekly.com to subscribe, or on LinkedIn. And yes, I am still on Twitter.
Amazing. And Julie?
Same LinkedIn, no Twitter. Sorry, Jason. Julie Arnoux, and of course the Wise website, so wise.com, and then you /platform.
Amazing. And Veronica?
LinkedIn, Veronica Maria Glab, and my Twitter's definitely not fintech relevant, just other nerdy stuff relevant.
Amazing. And me, you can just find me on LinkedIn at David BG. Thank you so much for listening to today's FinTech Insider. If you like what you heard, please make sure you follow us on your favorite podcast platform of choice. If you really like what you've heard, why not share the podcast with a colleague or friend? As always, if you want to join the conversation, find us on social media or just search for 11FS or FinTech Insider, or email podcast@11fs.com. Thanks again and goodbye. In today's fast-changing digital world, proving your company is trustworthy isn't just important for growth, it's essential. And that's why Vanta is here. Vanta helps companies of all sizes get compliant fast and stay that way with industry-leading AI, automation, and continuous monitoring. So whether you're a startup tackling your first SOC 2 or ISO 27001 or an enterprise manager vendor risk, Vanta's trust management platform makes it quicker, easier, and more scalable. Vanta also helps you complete security questionnaires up to 5 times faster, so you can win bigger deals sooner. The results? According to a recent IDC study, Vanta customers slash over $500,000 a year in costs and are 3 times more productive. Establishing trust isn't optional. Vanta makes it automatic. Visit vanta.com/insider to sign up for a free demo today. That's VANTA.com/insider.